Well, stocks are down right now. They tumbled overnight in Asia, not much better over in Europe. Let's get to our next guest, Jeff Palma. He's a frequent face on our program talking about the markets. He is a global equity strategist at UBS. And Jeff, last time we talked, I know that you weren't that keen on U.S. or Japanese stocks for that matter. Any more so after the earnings reports, after seeing M&A activity?
Well, I think the really good news, the marginal news in the very near term has been that M&A activity. It does suggest perhaps, I think the very hopeful sign would be that this is the first signs that we're seeing businesses willing to unload some of that cash that they've built up, maybe feeling a little bit more confident about things and willing to do some investment. On the other side, of course, though, we still see economic data coming in a little bit on the weak side, and I think that continues to underpin this tug of war that we're seeing between some of the more positive news about M&A and earnings and the macro side on the other.
Has that ever happened, though, where we've kind of come out and seen a better market because of M&A activity?
No, but I think it's about the early signs today about confidence. I think if we see continued M&A activity, it's not likely to occur in a vacuum. We're also likely to see in that environment more CapEx spending and more hiring, right? I think it's kind of all part of the process.
Right.
And that would be the link to the economy and therefore to a more positive tone.
Jeff, it's John Erlichman. Those are the pieces of the puzzles. Now give us the numbers. Are U.S. stocks going to finish higher at the end of the year than their current level or lower?
Well, based on our view that there's not going to be a double dip, I think higher is the right expectation here. I still think we're in a tug of war, and so it's not going to be a straight line, and it's going to be a pretty hard-fought battle along the way. But I think over the balance of the year, there's going to be evidence that growth is holding in there reasonably well. That should push markets higher.
Jeff, it's Sheila Dermartian here. Despite all that, you still think that 2011 earnings are too high and that we might start to see analysts bring those numbers down?
Yeah, we do. I mean, those expectations for 2011, it's probably worth taking a step back first and thinking about 2010. Globally, about 35% earnings growth this year, which is just a spectacular number. Another 15% is forecast next year. So cumulatively, more than 50% earnings growth. The sales numbers are not nearly that strong, and we just think that the expectations for margin expansion, additional margin expectations, are too high, and that's why those growth estimates have to come down a bit.
Jeff, I'm still fascinated, I can't help it, by that Morgan Stanley report out this morning, that mea culpa by Jim Caron, who basically said, threw in the towel. He's like, look, the bond markets were right. I was wrong. I thought yields were going up, but nope, they weren't. And they didn't, and they're not going to. What do you make of that? That's a pretty significant statement coming out of them.
Well, I think we've seen a lot of people misfooted by where Treasury markets have gone, not only this year, but over the last couple. Bond markets are still very much fixated, I think, on two main issues. The risks to growth still perhaps being to the downside, or at least that seems to be some of the consensus view. And I think very importantly, number two, about whether the Fed's going to enter another round of quantitative easing. If that happens, right, and maybe the Fed statement last week about reinvesting the dividends, if you like, from in terms of not shrinking their balance sheet,
right,
has put a bid into bond markets. It doesn't look like the Fed's ready to change their stance anytime soon. It's hard to back interest rates up substantially until they do.
And Jeff, against that backdrop, the high growth areas like industrials and consumer discretionary stocks have given up most of their gains for the year. So against that backdrop, and you said stocks will end the year higher, what stocks will go up? What stocks will go down?
Yeah, our preference from a broad sector perspective is not to be aggressively cyclically positioned, but for that matter, not defensive either. I think we're supposed to migrate more towards quality. I think it should favor large cap companies, ones with strong balance sheets that can survive this kind of an environment, ones that you can use their size to their advantage. Dividends become a pretty important story as well.
Right.
We do like technology, we like consumer staples, so a bit of a mix from a sector perspective, but I think quality is the name of the game.
And are you looking at cash?
Well, cash yields at zero, right? In order to basically have a favorable view on cash, you have to not like growth at all, and you have to think that markets are going to move lower. So, personally, I don't think that that's a great strategy at the moment. To the extent that you can get 3% and 4% and 5% dividend yields out of some stocks, that's a pretty attractive proposition relative to cash or even to government bonds.
Okay. Jeff, we are going to leave it there, but nice to talk with you. Have a good weekend. Jeff Palma,
you too.
The global equity strategist at UBS.